Hi, this is Garrett Goggin with Gold Stock Analyst. Today we've got John DeCooman with SSR Mining joining us. John is SVP of Business Development and Strategy with SSR Mining. Hey John, thanks for joining us.
You're welcome. Good to see you again, Garrett.
Hey, thank you for taking the opportunity. I wanted to speak to you today about your business, but to start off, I wanted to talk a little bit about the SilverCrest Metals deal. You paid $23 million for a 10% placement at about $2.80 a share in SilverCrest. I guess, I've followed your company for a long time. What I've admired about your company is you do a really good job with your cash reserves. You paid about $275 million for Marigold in cash a few years ago. You've built your cash balance back up to $400 million by adding value and bringing cash right back into your bank from the bottom line. So your company and your team does a good job evaluating resources to make them accretive to generate shareholder value. So what do you see in SilverCrest Metals that attracted you there?
Sure. I mean, fundamentally, we've looked at a lot of assets over the last 3 to 4 years, some of which have been outright acquisitions. This was an opportunity for us to get access to what we thought was a pretty above average quality ore body, right? Good widths, excellent grade, the tonnage stacked up when we looked at the resource. And it's in a country where there's been consistently success around development and operating of underground mines. You put that together with a group of people that have had success also in that same area. So this is their second time around, specifically in that area around both discovery and development, and a pretty well-established now treasury. When you combine that with what we have, they've got close to $50 million of Canadian, 50 million Canadian in the treasury. That is one of the issues that you've seen with a lot of these developers, where they've either not had the people that could advance the property, they've not had the cash to advance the property. At the end of the day, we saw an ore body that was worth advancing, gave us good exposure.
So, bottom line, how many times have you visited the project, and do you have a team of geos that's been there to evaluate it?
Yes, yeah, I mean, absolutely. It starts fundamentally with the resource model,
Okay.
and whether that be through an outright data exercise, which is certainly fundamental to any of the work that we do. We also conduct site visits. We've done a number of those over the last several years, and certainly the SilverCrest asset, Les Chispis, is no different. We've been to site. Can't say enough about the quality of the management team and their openness and willingness to, field our questions, provide us the data, access to on the ground. All of that's a very, very fundamental part to what you'd highlighted before around our cash reserves, and that is capital discipline, right? You have to be able to have boots on the ground, and we've been following this for close to 2 years now. So it's one of those where we've been able to test our own internal hypothesis around what we thought, what we could see, what we wanted to see, and it came to, I think, a good point in the evolution of the deposit and the management team, where they needed money and we wanted exposure.
It's interesting because your last two deals, you were Silver Standard Resources, and your last two deals were gold. So the vast majority of your production has been gold over the past couple of years, except for a little bit from Burkitas or Puna. That's going to be adding silver production soon. But now you're going back to a silver mine. Well, it's silver gold, and it's extremely low cost. So you're just looking at straight profitability and NAV IRR sort of stuff in order to evaluate it?
Yes, I think you'll see continued growth within the portfolio amongst all the assets, including the silver exposure of Puna. What this does is it gives us more opportunity within the portfolio to have a number of different, let's say, project options, right? And so what we look for, good quality ore bodies or better quality ore bodies than what we currently have access to. And, I would say that at the end of the day, we've continued to see, whether it be tons, grade, mine life extension through exploration, we've seen, an improvement in the quality of the portfolio. This just gives us another arrow in the quiver.
Would you say that grades are probably one of the most important factors that you look at when evaluating a project?
It's certainly, in terms of the quality ore body, grade, as people will say, is king, right? And there are a number of different factors that we get into, and that is ultimately also the developability of the asset. We think it's something that isn't going to require multiple hundreds of millions of dollars, 10 plus years of development history. there are a number of assets that might have similar, let's say, characteristics from a quality standpoint, but they're just frankly not developable. And what we're looking for is the potential to have a new mine. That doesn't necessarily mean that we would be able to outright acquire this, but we're looking for those types of ore bodies because we know that that will have value to anybody.
It seems like your sweet spot's about 250 mil as far as CapEx or an acquisition.
Yeah, I think that that's absolutely within reach. I think we could go farther than that up the capital curve if it warranted. And so, we're looking for anywhere from, call it, 150 million to less than 750 million. But absolutely, 250 to 500 million is a very good spot for the market cap of our company, the balance sheet, and probably, what we could handle from a management team standpoint. We don't want to bet the company around any particular opportunity, right? And that's been that capital discipline that we try to adhere to.
Right. SilverCrest to 750 mil, the SilverCrest metals. Are you disappointed that you were capped at 10% in the SilverCrest deal?
I think it's an opportunity for us to get exposure.
Okay.
So that, with a team that has the operating platform that they have down there, people did, and it was probably, I would argue, the single biggest question repeatedly that we got after the announcement was, why didn't you just buy the whole thing if you like it that much? And, at the end of the day, this gives us an opportunity to get access or exposure to a better quality ore body. It's in a country where we're going to continue within that part of the country to get comfortable with a management team that's familiar with that. It's still early days, right? There are a lot of technical studies that you have to go through. There are a lot of community agreements and permitting you have to go to. This is a team that has the skill set to move that, advance that. So we're really getting great access to augmenting the business that we have.
Right. Okay, that sounds good. So thank you for that update. Can we spend a minute talking about some of your other assets? To start with Marigold.
Sure. Yeah, no, another solid year there. It's a 200,000 ounce a year producer in Nevada for those that aren't as familiar with it. We've got some pretty good exploration ahead of us there. I'd say the real key catalyst has been that people have focused on this year has been the exploration of Red Dot. We've had consistent delivery this past quarter, the third quarter of 2018. We had record movement of material. A lot of your viewers, if they followed our story, recognize that really at the end of the day, Marigold's about moving dirt. And that has been a big driver in the single most important cost driver within that asset, which is the mine. Nearly 80% of the cost structure is within the mining cost of the overall total cost structure. The more material we can move, the more efficient that is, the lower our cost structure. We're moving 0.45 on average, 0.45 gram per ton material. And, that's something that a lot of people can't make successful. We've done that, again, through the efficiencies. Yeah. It's the exploration at Red Dot that people really need to pay attention to. But go ahead, please.
Why? What's the how many ounces are at Red Dot and what's the grade?
Sure. So currently at Marigold as a whole, we've got in the neighborhood of, call it, roughly 2 million ounces. But we've got an additional 4+ million ounces of resource on the property. So we're talking 6+ million ounces of total resource on the property. We've targeted specifically Red Dot because it's got roughly 1 million ounces that if you're able to convert that, and people could, if they refer to the November 2018 corporate presentation, they'll see what we're talking about here around the cross sections and what we're trying to move from the resource category to the reserve category. And so that 1 million ounces would increase, substantively the reserve base if it were ultimately to move over from the resource category to the reserve category. And so that's what's so important, is that ability to move that would allow us to then reconsider a larger truck fleet, a larger shovel fleet, continue to move down, because that would be the focal point, would be moving down the cost structure on a per ton unit basis. And that is in part important as we do the drilling. The drilling's going well. We've got some information that's out there for folks. And what we're geared towards is our February 2019 resource and reserve estimate. And that should telegraph to people the direction that we're going with respect to Red Dot.
And Important factor to note is that, your CapEx to potentially develop Red Dot, it'd be very small, right? Because the pit is very close to the current pit.
Well, what's driving the capital that you'll see there in the corporate presentation is just the equipment. The focal point for this drilling will also not just entail the potential to marginally improve the grade, but it's going to be that trade-off on strip ratio. Strip ratio has historically been, an important factor with Marigold because moving 0.45 gram per ton rock, you can't move a lot of waste when you only have a certain dedicated amount of net value in that ton of ore. So it's really the ability to move within that same, perceived cone, the ability to move into the ore category a little more tonnage from the waste category. And so if we're able to do that, there would be, and it's to be determined, but there is going to be capital associated with the pre-stripping. And so that would be that will be the overall total capital requirement to see whether or not that facet of the subset of the ore body can convert to the reserve case. So we basically got three scenarios. One, it upgrades sufficiently and it's a no-brainer from a return standpoint. The other is the drilling is completely unsuccessful and it remains a resource and investors maintain exposure because of the higher metal price, it would theoretically convert. I think the tough decision is going to come if you've got a, call it, single-digit IRR, and do you have to make the decision as to, do you, in a sense, act on that call option, or do you set it aside and you make that decision later on if there is a change in metal price?
Right. Okay. I gotcha. Thank you for that update. And then lastly, CB. I noticed third quarter, CB had a great quarter. It actually generated more profits than Marigold did, even though it does only half the production.
Yeah, I think people, even dating back to the announcement time in the April of 2016 time period, didn't have a full enough appreciation of, at roughly, call it, a 20th of the size of scale of what's moved on a daily basis. The production profile and the grade profile at CB translate into very solid EBITDA and cash flow margins that you don't see in some of our other assets. So we really got a nice complement. We've got large scale and a lot of exposure to the metal price when it moves. For Marigold, we've got a lot of stability and because of a lot of grade. We're probably one of the highest grade deposits, particularly in Canada, for an underground mine, right? So roughly at 10 grams per ton underground, and you're seeing some good grades this year. That stacked up improvement on the throughput, that's going to translate really to the bottom line, and you saw that within this quarter. This quarter is not going to be what we do every quarter, but it was an attractive quarter for sure, and it's an illustration of what it will do when the grades continue to come in and we get that production ramped up in 2019.
It's interesting what happened with a lot of the higher grade deposits up in Canada. Macassa, Kirkland really started. You get a good operator like Kirkland operating the asset with experience, and they can produce at extremely low cost, and you're doing the same thing with CB. And Lakeshore was similar to that also, kind of a high grade underground operation.
Yeah, I mean, certainly we've been pleased with what we've seen there. Good people. We're also being benefited from some of the unfortunate downturn of the mining sector in other parts of the province in Saskatchewan that's allowed us to pick up increased quality talent that we didn't have access to before. But that, along with a fairly large land position, well-funded exploration program, we're quite happy with what we're seeing. The ice road coming along real good for 2018 into 2019. That'll be critical to get the equipment that we had spec'd out in the capital plan for the PEA that we announced in 2017. That'll be important for that throughput number that we've put on the table for 1,050 tons a day, because we'll have a little bit of extra equipment coming in. We've determined and we've demonstrated that the mine is the bottleneck now, not the plant. The plant has historically been perceived to be that. Our view, dating back to even when we did DD, when we were there on the ground, was that plant can do a lot more tons. You've seen that consistently. We've got the scatter plots in our November 2018 corporate presentation to show that ramp up over time, and we'll continue to demonstrate that as we move into 2019 as the equipment comes online after the ice road.
Excellent. And we're looking forward to seeing what 2019 brings, but if your stock price is any indication, it looks pretty good, being at close to 52-week highs.
Yeah, I mean, we've got a lot of momentum now. I think that people are definitely starting to appreciate the exploration story, the consistency in delivering. This will be our 7th year in a row where we've delivered on production as well as cash cost guidance. So from that standpoint, we're pretty pleased. And as you look into the future, I think what people are focused on now that the primary or the bulk of the expenditures have been completed at Puna, you'll see that the capital at Puna will start delivering silver growth. And so margins in the business, as you look out over the next 1, 2, 3, 4 years, should be improving. But again, it's going to depend on your view on metal price in terms of the actual margin itself. But certainly, more production and the unit cost should be going down. That should be all good for the business model.
Yep, that sounds good to me. Thank you, John DeCooman, for joining us today, and we'll speak to you soon.
Always a pleasure. Take care.
Thanks, John.